applause as well. So thank you very much. My name is Yoojeong. I am here from Singapore today to talk to you about Asia income. This slide, I think it's just to check whether everyone's awake and listening, because I've made one error, and I've only got one job as an income manager to get the dividend yield right. But the dividend yield is actually 5.4%. So please cross it out on your interactive presentations and correct that for me. But these are the highlights of the fund. So you'll see that we have had pretty good performance, and I will go through a performance slide later as well. The fund has a very nice, attractive yield of 5.4%, and it is currently trading at a discount of close to 13.9%, and net gearing as well. So as a closed-end fund, one of our benefits is that we can take on gearing into the portfolio as well. So we always carry a little bit of debt in the portfolio just to enhance the capital gains that you can all receive, as well as to enhance the income we generate as well. And we can go up to 25%, but historically it has only ever been as high as 11%. So we moderate it depending on what we see as returns in the market versus the cost of debt to have this amount of gearing in the portfolio. So firstly, why Asia? Why is Asia exciting for dividends? I think most of you here will already know that Asia is predicted to be one of the largest contributors to GDP growth globally. So you can see the graph on the right takes you up to 2050, with Asia Pacific being the light blue portion in this graph. So pretty good growth rates expected for Asia. And I just draw your attention to the third bullet point, that already half the companies listed on the Asia Pacific ex-Japan index are yielding more than 3% dividend yield. So quite a good base that we're starting from, but we also see a lot of growth opportunity in dividends. And we show that here. So over time, over the past 23, 24 years, then dividend reinvestment, shown here in this turquoise light blue color, has been more than half of the total returns that you receive as investors in Asia over this pretty long time period. So again, I think dividends becoming very important in Asia. This slide, I can explain it to you in Q&A if anyone's very excited about how I came up with the chart itself. But essentially, a lot of people ask me, value has been so popular in the markets. Do I think it's going to continue? So you've seen this big rally towards the end. Towards the last 5 years, we've had a big value rally. So that's supported dividend stocks during this past 5 years. But if I go back over 25 years, there's only been 2 points in time where it has not made you money to be overweight value. And that's 2008, which was the global financial crisis, and 2021, which was, of course, COVID. So I think even if value does correct and we see more growth coming in, I would just really point back to the history we see here, that value is predominantly a profitable trade in Asia for everyone who invests there. Just a bit of an introduction to myself, as well as how we look for stocks. I am one of 40 analysts and fund managers located in Asia. So as I said, I sit in Singapore. I'm South Korean, and I sit next to a lot of different nationalities in my colleagues as well. So we have Chinese speakers, Thai speakers, Bahasa speakers. And I think that's really important, because if you have a 1-hour slot with the CEO of a company in Asia, then how they talk to you is very different if you engage with them in their local language. Also the internet. I don't know if anyone here speaks a second language, but there's really a second secret internet if you can search stuff on Google using the local tongue. So things like Daily Mail, for example, that some of you might or might not read here. The version of Daily Mail that we have in Korea or in China, the information you get, the gossip that you get about company owners, about trade in the region, is very different from what you might read from the FT that covers Asia here. So I think it's really important that we keep this local language and that culture alive within the team. And then we try and find stocks that are easy to understand, so businesses that we understand and that we can explain to our clients as well. Good quality businesses that generate good cash flows, that have conservative balance sheets, that can support dividend growth going forwards as well. So this is a performance summary till the end of April. So if you look longer term, so 1 year, 3 year, 5 years, you can see that fund net asset value performance has been very strong. It's also been beating the benchmark that we have, which is the MSCI Asia Pacific ex-Japan Index. Year to date, so we talked about this strong value rally, but year to date, we have seen a little bit more positive news coming out of the slightly growthier markets. So China has come back off a low base. India has also continued to do very well, although not today, after the Indian elections. So those growth markets coming back has meant that the benchmark has done slightly better. We, as value investors, have still delivered a positive net asset value return, but we're lagging that benchmark a little bit, and I'll show you how that comes through on a sector basis. So these are our sector weightings. The funds weightings are in light blue, and the benchmark is in dark blue. The top 3 countries, Taiwan, Singapore, and Australia, these are our biggest positions, and that's because they are the highest yielding markets in Asia. You'll see that we have quite big underweights to China and India, and that's really because these markets haven't historically been dividend-paying markets. So we're underweight these countries. Being underweight China has been a great relative performance boost over the past 3 years, but we are very aware that this market has corrected significantly, and of course there's high-quality companies within China that give us access to a really attractive population growth story, middle-class growth story. So now things are looking very attractive for us to find stocks at good prices that give us access to that growth. So I'll give you an example. We have invested in PICC, which is an insurance company in China. That might not sound so exciting as a way to play the consumer in China, but if you think about the middle classes, and if you think about people in China becoming wealthy for the first time in their family history, then now they want to buy savings products, now they have assets that they want to insure, and now they even want to think about passing stuff down as inheritance to their children for the first time in their family histories. So companies like PICC, which offer these insurance products that offer savings protection, I think these are going to be the ones that benefit from that growing middle class, growing wealth, rising levels of education story. So we're looking for different ways to try and play that consumption growth that might not necessarily be just by noodle makers in China. We want to get good access to this story, but we want to get it in an attractive way. So we're always looking for new ways to play growth themes. From a sector basis, you can see that we have an overweight to information technology, which might come as a surprise if you only look at developed markets where IT companies tend to be high capex, so they need to spend a lot of money to get the next iPhone out or to get the next technology developed. So they don't tend to pay dividends because they're always investing in growth. Whereas in Asia, we've got real big global powerhouses like TSMC, Samsung, brands that you might not have heard of. So TSMC may not be familiar to the local resident of Edinburgh, but it's in everything that you have. So TSMC is the global leader in semiconductor manufacturing. So it's in your phones, it's in your iPads, it's in the videos that's being filmed here, how we get stuff on the screen. It's also all the data usage that we do. So if you've ever used Google Maps or if you've ever played with AI or played a computer game, then these are all things that use semiconductors. And TSMC has over 50% market share. So this is a very exciting company in the tech space, sits on net cash on their balance sheet, generates very good cash flows, and is able to pay very good dividends as well. So a little bit of what we own, and whilst we are bottom-up stock pickers that look for quality, I've tried to group things into thematic verticals just so you get a sense of how broad dividends can be, how broad the base is in Asia to find dividends. So I've mentioned some of these technology companies already. So TSMC I just spoke about as the global giant of semiconductor manufacturing. But then we also have stocks like Sunon and Acton, and these are small cap companies that are less than $2 billion in total size. But they're very crucial supply chain manufacturers within that big semiconductor business that is so growth heavy in Asia. So Sunon Wealth makes the little fans that cool down your PCs and they cool down the data centers as well. And Acton make the logic switches in AI circuits. So not as high tech, but certainly very crucial to make sure that we get access to all this chat GPT and generative AI as well. Small cap companies, I think, are quite interesting in Asia as well. And I'll link this back to our 40-strong team based on the ground in Asia. Small caps are highly under-researched, but we, I believe, have a competitive edge in this space because we've been looking at these stocks for 20 years. We've been meeting management in their local language for 20 years. So we have about 20% of NAV in this fund invested in stocks with market cap below $2.5 billion US. And I think that, again, is a benefit of a closed-end fund structure. It also works to our strengths as stock pickers with that human sort of capital to cover all these different small cap companies as well. Another example, I've chosen India just because India, I think, has been a really good equities market in Asia. It was the strongest market in Asia in 2023. And you saw earlier that we are underweight India because it doesn't pay dividends. But of course, there's always exceptions to the rule that prove you wrong. So Power Grid is one of the companies that we own in the fund. It is like the national grid equivalent, but in India. So it's got a regulated asset base. It gets regulated cash flows. That supports a very healthy dividend. But there's also growth for Power Grid because India as a country is trying to electrify the nation before 2030. It's also got net zero targets for 2050. So all the renewables investments that Power Grid is doing is all towards the government's aim of making India cleaner, making India a leader in this climate change revolution in Asia as well. If you doubt what India can achieve, I would just remind everyone that India launched something called Aadhaar, which is their biometric ID system, and they were able to get 95% of their population, which is 1.2 billion people. They were able to get 95% signed on to Aadhaar within 1.5 years. And I don't know if anyone here knows how long it has taken the UK to get biometric IDs on everyone's passports. But the answer is that they still haven't achieved it, and it has been well over a decade since they started the program. So I wouldn't underestimate what India can achieve if they want to. And this is the share price movement of Power Grid over the time that we have held it since 2020. So not only has it done very well from a capital perspective, but it is yielding 4.4%, and that's versus a domestic Indian benchmark yield of 1%. So we're able to find good companies that give us good dividends, also good capital returns, and that's again helped by the fact that we have these 40 people on the ground just looking for new ideas all the time. The outcome of our investment process, again, just to prove to everybody that we really do focus on quality and that we look for the stocks that I've been talking about. So if you look at how the fund scores against the benchmark, then you can see that the fund beats the benchmark on profitability, on return on equity, as well as dividend yield, which are all quality measures. Bit of a busy slide, but just really to show you that valuations in Asia are still very cheap. So we're still able to find stocks at a reasonably attractive price. They are trading cheaper than the 10-year average of where they have traded versus MSCI World. So still attractive on a relative basis to the rest of the world. But it's also attractive if you look on the table on the right, then you're paying a pretty low price to earnings multiple relative to some of the developed markets. And of course, I haven't got it here, but if you think about earnings growth, then GDP growth for Asia on average is about 5-6% forecast for the next 2 years. Whereas if you look at the GDP growth estimates for developed markets, Europe, US, then obviously it's much lower as well. So you're paying a better price earnings multiple, and you're getting better earnings growth as well. And earnings growth, of course, leads to dividend growth, which is obviously what we're looking for in this fund. A couple of slides just on how strong I think the dividend capability of Asia still is. So we talked about how already 50% of the stocks in the benchmark yield more than 3%. But then when we look at the corporates, you can see that corporate balance sheets in Asia are much lower geared than the rest of the world. So that's the slide on the left. Asia is the line that's kind of green-blue, I think, like towards the bottom. So low debt on balance sheets relative to the US, relative to Europe. And then the slide on the right gives you a sense of how much coverage these companies have, how much free cash flow they're generating that covers the buybacks and the dividend commitments that they have. And I think, again, a very attractive story. Companies are generating free cash flows that more than cover both their dividends and buybacks, and that has been the case for a good 6-7 years in Asia. So you've got good yields in Asia, you have strong balance sheets, and you have good cash flow generation that still leaves room for these companies to increase dividends going forwards as well. That's important to us because we want to pay dividends to you. So we have 15 years of consecutive dividend per share growth, making us a next generation dividend hero fund under the AIC terminology. We also really like paying fully covered dividends. So if you look on this chart, you can see that we have been growing revenue reserves per share as well, which is shown in the dark blue. We used revenue reserves to keep our dividends during the COVID years. But since then, since 2021, we've actually been growing our dividends. They have all been fully covered, and we're adding back into our revenue reserve slowly as well. So we have about 40% of 1 year's dividend in revenue reserves. So if there was another catastrophic event globally, we would have something to play with then as well. Yeah. And this is just a summary slide of what we have spoken about so far. I just want to really stress that having access to these analysts and fund managers on the ground is really important to us. I think it really gives us an edge in terms of understanding the companies, understanding the markets, and that's something I would really like everyone to remember when they go home later, as well as the change to the dividend yield to 5.4%. And of course, the way we have built out our knowledge network, I think because we have been in the region a long time as a firm, because we engage with our companies, and I didn't mention this before, but we meet last year in 2023, we had 1,500 company visits, and we also did 600 or so proxy voting actions. So all the companies that are held in Asia Income Fund, we vote for all their AGMs, we vote for all their EGMs. I think that's a really important part of being a custodian for other people's assets, is to make sure that they are being monitored and that we are being prudent custodians as well. So we do all the proxy voting, we do all this engagement, so that we can remind ourselves that the holdings that we have within the fund are indeed quality companies. So all of these actions, I think hopefully with the people network, with the knowledge network, with the engagements that we do, we hope to deliver to you a fund that really focuses on giving you exposure to the growth of dividends and capital in Asia over time. So that was the entirety of my presentation. I have 2 minutes left, but also very happy to take Q&A as well.
Thank you, Yoojeong. Can we go to questions in the room? Have we got any questions? One just here, I think. Oh, excuse me.
Any share buyback plan in the future, 3 years or 5 years?
For the portfolio? Yep. So we have an active share buyback program, and that's something that the board is committed to as well. You saw on the first screen that we have a bit of a discount to our NAV at the moment. So it's pretty attractive valued to be buying shares if you can get shares at a discount to the net asset value. So there is a buyback program in place.
Is it anywhere on the website or any planned or announced somewhere?
Yep, it's in our annual report. So we are active in buybacks. There is a statement in our annual report that we will buy back shares when the discount is wider than 5%. But obviously that is a rule that was started a while ago. And since coming through COVID, we have widened the discount to more than 10%. So we are active, but we are not, near that 5% at the moment.
Any, the main holdings. first 5 or 10 main holdings
Yep.
changing in next 3 to 5 years, or
Sometimes they change, but I would just say we are a buy and hold type of investment manager. So if you look at our top 10 holdings, they stay pretty much stable, but there might be some changes in weighting, for example. So TSMC is our biggest weighting. It's 10% of the fund. The top 10 stocks together make up about 37% of the fund. TSMC, I think, is a nice example because it is 10%, but the yield on that stock is only 1.5%. So people often ask, why is it in the fund when you don't get the yield? But TSMC actually has been growing their dividend per share, the dollar dividend per share, every year for the last 5, 10, probably even 10 years. But their share price has done so well during that time. The yield has come down from 4% to 1.5%. But to us, it is still a very attractive holding because the share price is showing the strength of its business model. And we're also getting that increase in dollar dividend every year on the shares that we own. So yes, the yield has come down over time, but I think we look at it on a total return basis, and TSMC remains a very attractive choice for us still.
One last question. Your other funds, the 7 to 8% dividend, will this one be possible in the future, same from 5 to 6, 7 or 8%?
So I don't know what other fund you're referring to, but we are trying to increase dividend per share every year, as per the slide I showed you before. Yield, I think, is very dependent on how share price moves as well. So it's not just a function of how much dividends we pay. Yield can be driven by, it's a bit like TSMC, that we could increase dividend per share every year. But of course, if our discount closes or if our share price moves more than our NAV, then the yield might not show the same appreciation. So I wouldn't look at it on a yield basis necessarily. We have a pretty high premium to the benchmark yield because the benchmark yield is around 3% at the moment. So already at 5.5, we are considerably higher than that. But I think as you see dividends increase in Asia, we will also try and increase the dividends we pay. But of course, that yield ratio is something a little bit out of our control if suddenly share prices are driven up or driven down for whatever reason.
Thank you very much. Thank you.
So I just answered this lady's question. I don't have a size, but the program is active and we are still doing it today, but there isn't a cap on it.
Great. Did you have another question? Or? Yeah, of course, yeah, and then we'll turn to this gentleman.
Could you talk a little bit about the total expense ratio, please, for the fund? I may have missed it in your slides.
Yeah, so I might hand over to Paul for the total expense ratio. Okay, or I will come back to you just after this presentation. I just don't have the figures in my mind, but I just come back to you after this.
We had a question, I think, this gentleman here.
Am I right in saying, according to your graph, on the health part of your fund, it's a low weighting for Asia?
Yeah.
I noticed, yeah. Why is that? Because we've got 1.4 million people.
Yep. So healthcare, when you look at healthcare in the UK and in Europe, then you've got a lot of the big pharmaceutical companies that have big back books of branded drugs that are kicking off cash, and that helps them pay dividends. But when we look at healthcare in Asia, it's a lot of capex-heavy companies. So you've got the biosimilar manufacturers, and they have to build massive stainless steel tanks, and they still have to get FDA approval. You're fighting to be the first generic version of the branded drugs that come off patent. So there's a lot of money being invested into healthcare, but these are not necessarily the dividend stocks that you expect. So it's not like the Roche and the Novartises. These are like big, like Samsung Biologics. That is not a dividend stock.
Are you keeping an eye on that, though?
Yeah, of course. Yeah, of course. And I agree with you that given the population, although the pyramid is differently shaped, so if you think of the population pyramid in the UK or Europe, then obviously it's a little bit more inverted, so that trade to try and support the aging population is very different to the trade to try and support the growth in middle class in that lower section of the pyramid in India, in China. So I think, again, as we go through time, there is scope for healthcare to become more of a yield play in Asia as well. But just at the moment, we don't find good yield here. But as I said, we run portfolios on this team amongst the 40 of us that are not income constrained. So we have India funds, we have China Asia funds, we have unconstrained sustainable funds. So all of these products are also a way for us to generate ideas. We cover healthcare, we cover markets with no dividends, and if anything falls within our sort of sweet spot as income investors, then we're very willing to take a look at those. And like, not in healthcare, because it hasn't happened yet, but internet was something that we didn't invest in for a very long time. We didn't hold any of the Chinese internet stocks because they were too expensive and they had no yield. But after COVID, when prices fell, not only were valuations cheaper, but companies like Tencent felt the pressure of having to change their shareholder returns policy to attract foreign capital back in. So we initiated Tencent after COVID because it was cheaper, but also because they started a formal dividend policy to link dividends to free cash flow, and they started buybacks as well. So there can be change in any sector, in any country, and we are very willing to, take a look at everything. We're not constrained by the benchmark at all. This is just to tell you the story after we have applied our investment process and chosen all our stocks from a bottom-up perspective.
That's great. Any more questions? Just one gentleman at the back here.
Well, I just got to ask, you might hear me without the mic. I just got to ask, there's obviously some political risk in China.
My favourite
Taiwan,
question.
I mean, that's priced in by the market, I guess, today, and you continue with your strategy ignoring that, I guess, despite the fact that you're pretty low in terms of your China allocation today.
Yeah. Okay.
We've got bigger problems, I guess, if there were to be an issue there.
There would be bigger problems, yes. But I would be glad if everyone stayed invested, even if problems occurred. But I think when we look at China, we are not underweight because we are scared about geopolitical risk worsening. We are underweight China because we can't find dividend yield, but also because we don't find the same quality of disclosure and transparency of regulations. And I think that ties back to what you're talking about as well. So even though it's not linked to like the US poking China, I think we are aware that regulations can change, the government can change their minds about things. So it's a reason for us to be a little bit more careful about investing in China. I think you wouldn't find us having 10% weight in a single Chinese stock because there are certain risks associated with this market. But we would certainly like to get more exposure to that consumer in China. But we would try and do a more diversified approach to that. I think right now, tensions are sort of cooling between China and Taiwan. They have removed some fishing quota subsidies, for example. And last month, they started letting Chinese tourists re-enter Taiwan as well. So things are getting modestly friendlier. But of course, we've got this big event in November when US elections happen. And I think there's going to be a lot of market volatility, certainly, but people trying to figure out how the pieces will fall from now until November. That takes up a lot of mind space as well. So really for us, we're just trying to find what we believe are quality businesses that will do well regardless of what happens. Of course, if something bad happens, no one will be protected.
Indeed. Could I ask another question, please?
Yes, please.
And I don't see Vietnam on those countries. Is there a reason for that?
Yeah, so I like Vietnam as well. But Vietnam, again, very low yield country. And it's also one of those markets where there's a foreign ownership limit. So when you hit foreign ownership on Vietnamese stocks, then you start having to pay a premium as a foreigner to own Vietnamese names. So the highest quality Vietnamese names all have reached this foreign ownership limit. It means you immediately have to pay 7% premium as a foreigner to buy it. It can be bid up even higher. So there was a time when foreign ownership limit was 30% plus for some of these stocks. So the moment you buy it, you take a 30% write-off in your NAV. So there's a little bit of trade-off. So yes, we are long-term investors. maybe if I take a 10, 20-year view, then it would be something interesting, but it's quite a hard impairment to think about. So I think at the moment it's lower, so foreign ownership limits are not as high as they once were, because Vietnam corrected substantially over COVID as well. But again, with our small cap team, which is also in this group of 40 analysts that I spoke about, then we get pretty good coverage of Vietnam. And when the foreign ownership limits change, when yields change in Vietnam, then that will be something we're very excited to look at as well.
Excellent.
Well,
Just finally on the
Well, there you
charges
go.
question, it was 1% charge, and there's a ongoing management fee of 0.75%. Okay, thanks.
Brilliant. Cool. Are there any more? We've probably got time for one more quick question, or Roland, go for it.
How much of the portfolio is focused on the domestic consumer and how much is international?
Well, actually, we don't have the split, but if you look at the countries, then the big non-domestic stocks are really South Korea and probably Taiwan. So the technology companies, I think, are the big non-domestic trades. And we don't go for things like cars, which is also a non-domestic trade as well, because we don't think that has the same business moat. And the reason we've chosen to focus on tech in Taiwan and in Korea is because we think they have real dominance in that. I mean, they do have real dominance in those markets, but everything else is very domestic. So even Singapore, which is maybe not domestic Singapore, but it's very much dialed into the growth of the ASEAN region that they've expanded out into. It's all within Asia. We don't really look for export stories as much. We are trying to capture that domestic growth story, whether it be in China or ASEAN or India, because even the Singapore weight that is so big, within that we've got companies that are listed in Singapore. So like the India Trust is a REIT that is listed in Singapore, but it only invests in business parks in India, in Bangalore, where the big IT services companies are. So blue chip global tenants, or the call centers, that's all handled by the India Trust in Singapore. We also have companies like OCBC, which is the bank in Singapore, but they have grown through acquiring SME lenders in China, also having subsidiaries like OCBC NISP in India, in Indonesia. So they're constantly trying to grow from their sort of localized area. But I think that's what we're targeting as well. When there's such good GDP growth forecasts in the region, I think that's the most attractive trade, rather than trying to find companies that are trying to go outside into developed markets, except for tech, because tech, I think, has a good sort of boost under it with AI.
Brilliant. Thank you very much, Yoojeong.
Thank you.
Thank you.